The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. The global bond sell-off deepens with the 10-year Treasury yield hitting a 14-month high, while the 10-year JGB yield hits its highest level since 2011. Tech stocks pushed the Nasdaq to its fourth negative session in a row. Sentiment taking a hit after President Biden issues new curbs on AI chips.
The dollar index hitting its highest level since November 2022, keeping its global peers under pressure. Plus, crude prices easing, but remaining near a 4-month high after rising almost 10% since the start of the year. Good morning. Hello. How are you?
Very well, thank you.
It is very easy for us now to look at the equity market and go, oh, that was so obvious. It was so obvious. Nasdaq selling off, S&P firm, Dow firm. Oh, it's a rotation. I don't know if it's a rotation or not. I think it's really early days. And I think one move on the markets is too minuscule to even factor in as the beginning of the rotation. I think there are some massive moves going on, and it ain't the equity market, ladies and gentlemen. There are three places you got to look as well, and I think even the team have very kindly read my mind and put up a board as well. There are three things happening that are moving quite aggressively as well. The oil price is moving dramatically higher from near $70 a barrel for Brent not so long ago, now over $80, albeit coming off in the current session. You've got the US Treasury yields trading at the highest level since late 2023 as well, nearly 5%. And by the way, last time that happened, there was a big correction as well. And you've also got the dollar, which is absolutely surging. And that's creating all kinds of tensions in the money-raising market as well. So we spend way too much time looking at the equity market. I would suggest, ladies and gentlemen, these three assets and these three asset classes are where you need to look.
Well, this is what the bond markets are telling us, that inflation could be a problem. And as we creep closer to that 5% handle, let's face it, is on the horizon when it comes to that 10-year yield. Is it just too hot to handle? You've had a market environment where there's been a US exceptionalism story since we kicked off this year, and a lot of pivoting towards those US assets. And I think as a result, the market has just stepped back and said, is 5% too hot to handle for now? And I don't know about the rotation story, but I do know that it's too hot to handle for US technology stocks. And it was another excuse that was served up, whether it was around AI chips and further restrictions. But I'm not sure that was really the root cause of some of the selling on the technology platform. It was really the idea that borrowing costs are going up. As DataTrek was looking at some valuations here, and this is the other element. We're on the cusp of earnings season, and the reality is what's now baked into some of these trades. DataTrek was saying 53% of the S&P 500's value is now based on expected future growth on earnings. It gets worse when you take a look at some of the big tech stocks. That's about 67%. For Tesla, it's 92%. For Amazon, it's 72%. So it is telling you that we have really got our fingers crossed, hoping that those earnings are going to be forthcoming. And now an environment, if we're talking about higher for longer on rates, that could chip away at some of the earnings profile.
Yeah, we're on the same page. And you look at also the data. Oh, you've got to be data-driven. Yeah. Oh, now we're looking at the data. People should always be looking at data. I don't understand what the phases are when we're not data-driven. But tomorrow we have CPI, and it's going to be relatively hot. It could be as high as a 2.9 handle for the headline figure. It could be a 3.3 on the core. And every single one of our viewers is smart enough to know that 2% is the target. But if we get near it, that's fine. But used car prices, they're going up. Airfares, they're going up. Car insurance, they're going up. They're the three big factors, according to some of the investment banks. But going back to where I joined the show, gasoline's going up. The oil price is going up as well. So A, what's that going to do to the Fed? And B, there's the small matter of in 6 days' time, the new president could exacerbate all of these concerns with his policies.
Which is a great conversation to have around sentiment. and whether now is the time to dip one's toe in the water after we've had a sell-off on markets, or whether there's still too many moving pieces that could roil market sentiment. And just to the first point around CPI, I mean, we're discussing after the non-farm payrolls that perhaps that might be the end of the Fed's easing cycle. If we look at the expectations now, there's still some hope alive that we will at least get one rate cut this year. Markets are pricing 29 basis points of cuts from the Fed this year. So if the CPI does come through too hot for the markets, then that final hope of any rate cut could completely evaporate this week. So that is the first port of call with the inauguration. And who knows what we're going to get. Every day it's a different piece of news flow that could impact a sector of the market, impact the global economy. I think that is still the big unknown for markets. But let's just recap some of the action that we saw yesterday. Tesla, one of the big moving stocks to the upside for the major boards. You can see the S&P 500 just inching ahead about 0.1%. It was the Dow that had the firmer trades, United Health to the upside. Undermining the trade somewhat was a chip stock. It was Nvidia again that was moving to the downside for the major boards. For the Nasdaq in particular, Nvidia stripping away at 35 points on the index. So fourth negative session in a row is what we're still seeing on tech stocks. Close up, look at those big US tech names, Palantir, Nvidia, Apple, Micron, some of the names moving the most in session. Palantir down 3.4%, Nvidia losing steam. I think a lot of investors tallying up the Apple losses as well. Questions around just what that AI strategy looks like. The stock is down 1%. And you can see Micron, again, as we talk about chip plays, shedding to the tune of 4%. Very much in sight as we talk about further restrictions on countries beyond the United States and its allies receiving access to high-grade chips. I want to take you to Treasuries. And this is the epicenter of some of the pain trade. 4.76 at the 10-year. The 30-year, you can see, is still just shy of that 5% handle, but very close. It is 4.95%, so only a whisker off that 5% handle. Global yields also still being dragged along, and it's the UK that we've been talking about in the context of international markets and whether their fiscal headroom has been eroded. That 10-year gilt, we are just right smack bang in the middle there of the other major charts, as you can see, and we're 4.88 morning session. The dollar crosses, dollar is king, and that is eroding some of the advantage that you're seeing elsewhere. Euro dollar this morning, we have climbed back through 102. We're 102.46 at this stage. So we were hovering near a two-year low in the Monday session at 101.77. So we've managed to regroup and push off that level. Cable, we're 122, just tipping above that level this morning. Dollar yen, we've been closely watching this pair as well. We got to 157.5, roughly around a 6-month low the other week. And you can see we're 157.65 dollar losing some steam versus the Swissy. To the Asian markets, and we've got Japan returning today. The Tokyo stock market quickly giving back territory, down more than 1.8%. Elsewhere, we're perched stronger right across the board. Very strong day for Hong Kong and the Shanghai market, more than 2% in the green. The Kospi modestly firmer, so really mixed picture across that region.
Right, I think we've covered a lot of ground. We need an expert on this as well. Donald Trump's economic team is reportedly weighing introducing tariffs gradually on a month-by-month basis. This, according to Bloomberg, which says the president's advisors believe imposing duties of a 2 to 5% a month level, rather than all at once, would help avoid a sudden spike in inflation. No, really. Thank you, everybody. That's amazing how this works. Hang on a second. I didn't think it was going to cause inflation in the US because it was going to be the sellers of the product who were going to have to pay all of that rather than the US consumer. Wasn't that the pre-election? Anyway, they don't want to spike inflation and they do want to boost Washington's leverage in trade talks. Incoming Treasury Secretary Scott Bessent is said to be among the plan's supporters. The White House says it will cap the number of AI chips allowed to be exported out of the country as it seeks to keep advanced technology between it and its allies. The new rules come as the Biden administration enters its final week in power, with the Commerce Secretary Gina Raimondo saying the plans will safeguard the US position as a global leader in AI development and chip design. The rules will also see cloud service providers require special authorization to export chips for data centers outside the United States. Bayat Wittman is many things. He's a chairman and partner at Porter Advisors. He's also someone we've come to love to speak to over the years, and we continue to do so. So how are you, my friend?
Very well, thank you.
Good to see you. We're all heading to Switzerland next week. And you know, I've had a few calls, Karen's had a few calls of the different panels and things we're doing. And it's the easiest Davos I think I've had in years. Because despite my host's protestations, the hottest question is Trump? So whether it's food systems, Trump. Whether it's growth, Trump. Whether it's AI, Trump. I think you have to ask, what is the Trump impact as your primary question? Because I think that's what everyone wants to know, isn't it?
Yes, absolutely. But I think his unpredictability somehow is pretty predictable.
Well, the unknown is known.
Exactly.
You sound like Rumsfeldian this morning, my friend.
So I would advise anyone to focus on being ready for action and not simply to run around hysterically and trying to react to something. So I think that would be good advice.
Yeah.
It's funny, while a lot of us are waiting impatiently on the sidelines for some sort of Trump policy, the bond markets are not. They're very active at this stage. And as we kicked off the show talking about getting closer to 5% on the 10-year yield, what does it mean for the prospects of fairly decent stock market returns this year? Is that on ice at this stage?
Well, I think Trump is not the master of the universe, but of course he's the most important man, geopolitically speaking, no doubt, and the US economy. But the master of the universe is the US bond market. So I would save all energy to analyze that one instead of the revolving door of advisors and of media noise. And we should just put things into context. The US market has delivered more than 20% in 23 and 24. That's statistically very exceptional. So the third year will be more modest if you want to be positive. And that means I would advocate a defensive posture right now. The Trump trade, strong dollar, strong equity market came in anticipation of the election already, then with the election, and now there will be the inauguration. So I think the US bond market somehow in its decline is in overreach. The US equity market is in overreach, the dollar is in overreach, so we are at the back end of a development of the last 2 years. And Trump, of course, is fire on top of fire. And so I think going into the next few weeks and months, a defensive positioning is important.
Why is the dollar in overreach? It makes total sense to me. You've got an economy firing on all cylinders. You haven't in UK, you haven't in Europe, you haven't in Japan, you haven't in China. What haven't I covered? And you know that actually all of those regions could be the target of these tariffs as well. Economy on all cylinders, higher inflation in the US than previously expected, plus concern for the other side of the trade. Is the dollar in overreach?
I think technically yes. But of course, fundamentally, it's absolutely justified what the dollar has done in terms of interest rate differentials. It's absolutely justified what the S&P has done the last 2 years. The growth, the productivity, we are at the cusp of a big productivity cycle. The positioning of the US in defense, in finance, in energy, in technology is unassailable. But, it's in the sentiment, it's in the price, it's priced for perfection right now. And I'm not saying the trajectory over the next 2-3 years is not positive. I think it's positive for equities, but there is a pendulum always, and there's a mean reversion somewhere.
That said, we're going to hear a lot about the intelligent age on the mountain in the next week or so. It's all about AI and how this technology is going to change our lives. We had a guest sitting there the other week saying, look, we're not even getting close to the middle of the S in the belly of the curve as we talk about this new technology. Why is 5% off the all-time highs on the NASDAQ not an entry point now?
Well, I think it's interesting to look at the developments at the end of the 90s. Yeah, in technology, media, and telecoms. We had this huge boost in terms of performance, and then we had a big correction. But then the underlying performance of that sector over the following 3 to 5 years was very, very positive. So I think there has been a lot of anticipation right now. But now the data, the results have to live up to those valuations. That's it. So I'm very positive on the trajectory, on the fundamental impact of AI and technology. But it's a matter of pricing.
In terms of, and I want to pursue Karen's point because I think it's the right question, is if you are an investor, not a trader, we know that some of you lot out there pretend to be investors, but you're really traders, and you only become investors when there's a bad trade, isn't it? Well, every investment is a trade gone wrong, which is not true, but you see what the point there. In terms of stocks that we want to own over the medium to longer term, do you think the valuations ex the growth sector look compelling? I'm talking about some really big, important names across Europe and globally who just haven't motored in the last couple of years.
Not right now in technology.
Not
Because
technology, but elsewhere. Ex-growth, I was saying.
Ex-growth, yes, the valuations are compelling also in the US market. And we see some rotation right now, and that's very healthy, of course, for the overall market.
But my point being as well is, and I specifically said globally as well, because you've got ex-growth in the States, which is at a discount, but it's still well bid compared with what we're seeing elsewhere. So you've got your pecking order, haven't you? You've got your growth shiny stuff, and then you've got the smaller growth stocks, and then you've got your value stocks in the US, and then after that, it's the rest of the world. And so when you look at the cheap of the cheap, you see value stocks in Europe that just look beaten up. But the problem is they've been beaten up for a very, very long time.
No, I clearly think that the G7 markets are interesting and they are great value compared to the leaders of the last 2 years in the US. So I would definitely invest in Europe and overweight Europe relative to the US. And that's true for the G7, including the UK, Japan, etc. That's absolutely clear for the next few months because they are going to benefit. And the pessimism is rampant there. The valuations are rock bottom. And of course, these corporate sectors are in creative destruction modus, especially in Germany, in continental Europe.
What's going to create the balance for Europe, though? Because it feels as though you might be almost a solo voice calling investments in Europe at this stage. A lot of people are quite bearish around the prospects here. So what is the trigger for some sort of bounce back in Europe?
Well, the trigger is the need for reforms. We have German elections, and I expect clearly that there will be some reform of the debt brakes and the debt brake mentality and some fiscal expansion. And there's plenty of room for the ECB in terms of inflation backdrop to lower rates. So the interest rate differential to the US is going to widen. That's one thing. And then, of course, there is a new EU Commission in place who has to tackle key topics like capital market union, banking union. I expect that the fragmentation step by step will be overcome. And then the big thing in the room is defense spending. Trump is putting a lot of pressure, very rightly so, I think. And the European defense industry and industrial military complex has to overcome fragmentation. And that's also a technology business in today's world.
Sorry, Karen.
I just very quickly want to follow up on your rotation point, that we are seeing some rotation in the market. If you want to play that theme over the next few weeks, which areas do you think will benefit from rotation?
Well, I would simply focus in Europe on a Euro Stoxx 50 on big cap stocks because the money goes into big cap stocks, nothing else. Right now, if there is some change in asset allocation, and then to see how January is developing in the US will be interesting. But the US bond market is really now heading to 5%, and that's really very difficult for equities to follow up short term.
Just asking for a friend before we go. How far from Davos are you?
1 hour.
Okay, just in case I need a bit of respite, stick on a pair of slippers, just chill out for a couple of hours.
Beat won't be there. He'll be off skiing.
Even better. You leave the key under the mat.
And there's a lot of snow there right now, so it's all fine.
Just in case Davos drives me absolutely bonkers, I was just wondering if I could pop in for an hour or two
Absolutely.
and just decompress. Oh, I love you for that, even more. Thank you, Beat. Nice to see you. Beat Wittmann, Chairman and Partner at Porter Advisors. And of course, we have Davos, and it's really exciting. And Karen and I have already been on 100 calls to try and give you the best coverage and the best moderated panel. So don't miss our coverage of the World Economic Forum. I hate that photo of me. Karen and Dan look lovely. At the annual meeting in Davos, Switzerland. I'm becoming more vain as I get older. We'll bring you conversations with top policymakers and executives from across the globe. It all kicks off Tuesday across CNBC TV and online and live on this CNBC International News YouTube page for all you millennials.
I think Dan and I look like we're auditioning for a toothpaste ad in that photo.
And I look like your old granddad standing behind going, yes.
Coming up on the show, a cosy year for Brunello Cucinelli as the luxury brand known for its cashmere sweaters reports a double-digit jump in full-year revenues. We'll have those details next. Plus, could ByteDance sell its US TikTok operations to Elon Musk? We'll have more on those reports And we'll discuss the outlook for energy investment in the US and the UK with Brian Gilvary, the chairman of INEOS Energy and the former BP CFO. That interview is at 7:30 GMT.
When I say US president, I have to say Joe Biden as well now, because we don't know which is which, do we? Let's be brutally honest about it. They're both acting as president in different ways. It's the truth. US President Joe Biden says Israel and Hamas are on the brink of a ceasefire deal. This is terrific news if so. That would include the release of hostages after a midnight breakthrough in talks. Dan, there have been so many false dawns. We began seeing reports about this yesterday. Please fill us in the details and why this one, if any, may have more legs than other ceasefire deals.
Well, it's a good point, Steve. First of all, why does it have legs? Because time is of the essence. We know the Biden administration has been seeking to get a deal done before President Trump returns to the White House next week. So ceasefire talks appear to have reached a critical juncture, and senior officials have been telling NBC News that we could be close to reaching an agreement as soon as this week. What we've seen over the last 48 hours is mediators from Qatar, alongside representatives from Israel and the United States, putting forward a draft of a ceasefire agreement yesterday after what's being called a breakthrough in talks. NBC News reports it is a very complex three-phase agreement that is currently on the table. In the first phase, Hamas is expected to release hostages, including vulnerable people first up, such as women and the elderly. This current proposal also calls for Israel to withdraw from populated areas of Gaza to the Israeli border, but of course the exact details remain unclear at this point. And of course several key issues remain unresolved here. We still don't know exactly how long this ceasefire is going to last, if indeed it does come to fruition. And of course we don't know what it means long term for Israel in Gaza either, and that is a major sticking point for the Palestinians and for what is left of Hamas. More details are expected soon as well. What we do know, though, is, as I mentioned, the Biden administration reportedly rushing to finalize this deal before President-elect Trump is inaugurated next week, which is, of course, adding new pressure to these discussions. So we're likely to get more information trickling through over the next couple of days, perhaps the next couple of hours. But just based on what we're hearing from the administration now, particularly on the American side, it would appear that good progress is being made and we could see a ceasefire perhaps before the end of this week.
Dan, you and I have spent a long time during this crisis explaining to our viewers why the oil price uptick every time we see a flare-up in some of these conflicts is not necessarily logical because of who the players are in the oil market compared with where the geopolitical tensions are. But having said that, if we do see a release of hostages, we do see a ceasefire as well, do you see any ramifications at all for the oil price?
It's a really good point, Steve. I think we could perhaps see some kind of a relief rally. What it would signify is an easing of tensions in the Middle East. What the exact geopolitical risk premium in this market is right now, of course, remains to be seen. But as it stands, oil has moved higher in the last 24 hours and in the previous trading session off the back of the US's latest push to sanction Russian supply. Exactly what happens in China and in India, which are the key buyers of that Russian crude, whether or not they're going to be able to find workarounds for their refiners to bring in those sanctioned barrels remains to be seen. And of course, OPEC Plus also sitting on the sidelines here, watching all of this unfold, ready to act as well with plenty of supply and barrels to add back into the market if we did see any barrels coming off as a result of US and UK sanctions. But whether or not we see that relief rally is, of course, a real question in this market right now. What it could look like, of course, also remains to be seen, particularly as we see a lot of other financial forces impacting the direction of crude. Now, right now, particularly what's happening with the US dollar right now and King dollar trading at the highest level that we've seen in around 2 months. Of course, we have gyrations in global bonds, the risk premium coming out of equities as well. Lots of uncertainty about what the US Federal Reserve is going to do given the strength of the data in the United States. I would say the crude price is really being driven by financial forces right now and the headlines rather than the fundamentals.
Thank you for listening to Squawk Box Europe Express.
For more market moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.